VW intends to close at least 3 plants in Germany and slash tens of thousands of jobs.
Volkswagen is in serious trouble. Factories are closing, employees are being laid off. The carmaker desperately needs help. The German economy is facing a severe downturn. Quarterly results were released today, providing key information on the company's outlook. We'll take a closer look in the video below. The plans that the company has now revealed cannot be ignored. Volkswagen is set to close at least 3 factories in Germany, and massive layoffs are on the way. This is a move unprecedented in Volkswagen's 87-year history. Let us look at what this means for the employees, for the German economy, for the future of the car company, and most importantly, for us investors who want to make a profit. Hi investors, this is Milan from 𝗕𝗂𝗋𝗕. None of the information in this video is investment recommendation. Always do your own detailed analysis. According to a statement from the employees' representatives, Volkswagen management wants to close at least 3 plants, cut tens of thousands of jobs, and reduce the salaries of the remaining employees by 10%. Why is Volkswagen resorting to such drastic measures? It is clear that the company is facing huge problems, not only because of competition in China, but also because of the decline in sales in Europe. Volkswagen management estimates that they are now selling 500,000 fewer cars a year in Europe than before the pandemic. That's basically the equivalent of 2 closed factories. The company also reports that the cost of running factories in Germany is 50% higher than they expected. This means that Volkswagen is currently producing at twice the cost of its competitors. 𝗕𝗂𝗋𝗃𝗧𝗋, chairwoman of Volkswagen's Works Council, said the company plans to close at least 3 plants in Germany and further cut production at other factories, putting thousands of jobs at risk. She stressed that the move cannot be seen as a negotiating tactic. It is a genuine plan to hedge the company against falling demand and high costs. At the same time, 𝗕𝗂𝗋𝗃 called on the German government to support domestic industry and prevent widespread layoffs. Workers' representatives, including the powerful IG Metall Union, are warning of mass protests and even strikes. The lead negotiator, Thorsten Groger, described Volkswagen's plan as dystopian and vowed fierce resistance if the company decides to continue with its current policy. The IG Metall Union has announced that tens of thousands of workers are prepared to express their disappointment with management if they do not agree with the company by December on, at the very least, better redundancy terms. Analysts say Volkswagen's approach reflects a combination of several adverse factors: competition from China, falling demand for electric cars that is failing to meet expectations, and regulations that are driving up costs. Volkswagen has lost 44% of its value over the past 5 years. Whether that was enough to drive the company below fair value, all 𝗕𝗂𝗋𝗃 Black members know, not only because of the fair price feature, but also because you can find all the information to do your own analysis of the company on 𝗕𝗂𝗋𝗃. This situation comes at a time when the German economy is close to recession and Olaf Scholz's government is looking for ways to boost growth. Government officials said they are aware of the situation and plan further discussions with Volkswagen and union representatives. We need to protect jobs while finding a long-term sustainable solution for German industry, a government spokesman said. What does Volkswagen's management have to say? Passenger car division CEO Thomas Schäfer openly admits that productivity in German factories is not at a competitive level and that labor costs are too high. Another problem that Volkswagen mentions is the fact that many activities are still handled in-house, while competitors have already switched to outsourcing, which is cheaper. Here he is referring mainly to software, where European cars in general have been lagging behind in recent years. Head of Human Resources Gunnar Kilian added that the situation is serious, and unless the company takes radical measures, it cannot afford to invest in the future. In response to a request for comment, the company said it was not involved in speculation about confidential negotiations with the IG Metall Union, which represents a large part of the company's workforce. Volkswagen is at a crucial point in its corporate history. Without comprehensive measures to restore our competitiveness, we will not be able to afford major investments in the future, said Gunnar Kilian's HR representative. Among the reasons for the necessary restructuring is the fact that the European car market has shrunk by 2 million vehicles since 2020. It is now stagnating and will not recover anytime soon. Volkswagen has a market share of around 25% of this market. According to the figures published today for the last quarter, only Porsche and Skoda are basically doing well. Volkswagen has only a quarter of the margin on its branded cars versus Škoda, so it's clear why the company is now pushing so hard to cut costs. Premium brands like Bentley and Lamborghini have margins only slightly above retail. The company also confirmed its outlook for the rest of the year, adding that there have been 2 reductions from the original figures. For Q3, VW only earned as much as Google on financial investments over the same period. In China, operating profit fell 37% year-on-year. We may also see a possible dividend cut due to cost cutting. Earnings per share lagged by 3.3%. Sales, however, beat estimates and came in at 78.48 billion euros. The stock reacted to the results by rising 2%, partially reversing yesterday's loss. If you want to know not only the fair price of Volkswagen and be at the heart of the stock market, become a member of 𝗕𝗂𝗋𝗕𝗂 Black. Plus, you get detailed stock analysis, news on portfolio companies, or a portfolio P-tracker with dividend calendar. However, the problems Volkswagen is facing are not only affecting the car maker. Other German concerns, such as Mercedes-Benz and Porsche, have also already announced cost-cutting measures and a reduction in their operations in China due to lower demand. In addition, the possible trade conflict between the EU and China, which could affect the prices of Chinese electric cars on the European market, is also a cause for concern. You can easily compare European and Chinese stocks on 𝗕𝗂𝗋𝗕𝗂. Just take a look at the octagon scores of the selected companies and you will immediately know which company is now more interesting. And how is the market reacting? Volkswagen's shares initially saw a rise over the past year, but in recent months the price has only fallen, reflecting uncertainty over restructuring plans as well as falling sales. Since the beginning of the year, the company's shares have fallen by around 20%. Investors remain skeptical as it is not yet clear whether these radical steps, coupled with more factory closures and further production cuts, can bring the carmaker back on track. Volkswagen operates a total of 10 plants in Germany, 6 of which are in Lower Saxony, 3 in the eastern state of Saxony and 1 in Hesse in the west of the country. The company is now at a crossroads where it has to deal with pressure on profitability, increasing competition and technological innovation in which it is lagging badly with its traditional role as a major employer and industrial driver of the German economy. The unions are not giving up yet and are going to fight hard for workers' rights. The outcome of these negotiations will affect not only thousands of families in Germany, but also the economic direction of the whole country. Volkswagen reminds us at this crucial moment that even the largest corporations have to adapt and that even the strongest economies are not immune to the changes in the global market. We've discussed our view of current events across the sector along with other automakers in a recent video, so check it out. Good luck with your investments.